What's up, guys? It's your boy Danny Valencia, aka Bearded Banker, back with another video, NMLS number 957014. Today we're going to talk about points or discount points and what they are. So if you're in the market to purchase a home or refinance a mortgage and you're talking to friends and family and your loan officer and realtors, you might have heard the term points and you're not sure what they are. We're going to cover that in this video. So points or discount points are fees that you can pay to buy your rate down lower than the market rate or the par rate as we call it. Now, the market rate is specific to you in your scenario. So if, let's say, for easy numbers, with your scenario, your down payment, your debt to income ratio, your credit score, your loan to value ratio or down payment if you're purchasing, all that into the system is yielding you an interest rate of, let's say, 4% for easy numbers. Now, the 4% isn't the only rate available to you. It's on a scale, and it's kind of like Goldilocks and the Three Bears, right? So there's higher rates, there's lower rates, and then there's something in the middle that might be best for you. So we have to determine what makes the most sense. Now, a lot of times a bank will just quote you the market rate, and they'll say, hey, your rate's 4%, and never tell you the difference, or that there's an ability to get a lower rate, but there is if you're willing to pay points. Now, the points are given to us by our bank or the investors that buy loans from us, or the brokers if you're dealing with a broker. The banks give us the rates and they fluctuate every day, just like the stock market. So let's say, for example, your rate is a 4% and you want to see if there's lower rates available. You can ask your loan officer, hey, is there any way that I can pay points and get a lower rate? And chances are you can. So interest rates work on a scale, and there's typically 1/8% increments in between every rate. So it'll go from 4% to 3.875, 3.75, so on and so forth. It can go all the way down into the 2% range. We saw rates in the high 1% range in 2020 when we were in the thick of the pandemic. So you can take advantage of those rates. So 1 point equals 1% of the loan amount. So let's say, for example, your loan amount is $300,000. So 1 point would be $3,000. But the scale and the points for those rates can be fractions of a point, or a point and then some. So back to our scale, if we're at 4%, maybe the 3.875% is only costing a quarter of a point or half of a point. That would be $1,500 if it's a half a point added on top of your closing costs at closing as a one-time fee. And then if you go down further, maybe 3.5% is 1 point, and that's $3,000 based on your $300,000 loan amount. And you can go further and further. Maybe a 3% flat is 2 points. It's going to cost you $6,000 right now, and then you'll have a 3% instead of a 4%. Now, when does it make sense to buy points? So the standard advice is, if you're going to be in a home for an extended period of time, let's say this is your dream home and it's 4 bed, 3 baths, your whole family is comfortable in this house, you plan on being here for 20 or 30 years until your kids are grown and out of the house, and then maybe for retirement you'll think of downsizing. If that's the case and you plan on keeping this mortgage for that time, and with rates as low as they are now, we're filming this in January 2022, then it could make sense to get the lowest possible rate you can, because let's say you buy it down from 4% to 3%, your payment's going to be lower and you're going to pay less interest over the life of the loan. So I'll pay $6,000 now to save maybe 30, 40, or 50 down the line. That's the thought process of buying points. Now, at the same time, if this isn't your dream home, maybe you're a first-time home buyer and you're buying a 2-bed, 1-bath condo or townhouse or single-family home, and you're just gonna stay here for 5 to 7 years, and then maybe when you get married and start a family, you're gonna look to expand and trade up into a bigger house. If that's the case, it could make sense to go the other way. It could make sense to take a rate that's higher than 4%, maybe 4.25% or 4.5%, and by doing that, the bank will give you what we call a lender credit to help you with closing costs. So the bank knows that on 4.25% and 4.5%, they're gonna make more money. So over the life of the loan. So for them, it makes sense to give you some money back for you to incentivize you to take the higher rate. So it might be $1,000, $2,000, $3,000. It's on the same scale, 1 point, 1.5 points, whatever it may be, depending on the market that day. So for you, first time home buyer, you're putting your 3%, 3.5% down, you're covering all the closing costs. Maybe it's not going to leave you with too much money when you're all said and done. You could take a higher rate if you qualify for it and get $2,000, $3,000, $5,000 off of your closing costs and keep that money in your pocket. That'll give you a big, peace of mind and chunk of change to work with after closing, just to have a safety net just in case. So rates aren't, specific and the same for everyone. They're tailored to your unique financial situation and what your goals and plans are with your home and with the mortgage. Also, when you're looking at advertisements online and you see these super low rates that look too good to be true, you have to look at the fine print, because a lot of time banks will advertise a rate and then the fine print, it'll say this rate has a cost of 1 point and it has an assumption of 20% down and excellent credit, blah, blah, blah. So you have to look through that as well to make sure that you're looking at a market rate and comparing apples to apples when you're shopping around. Definitely talk to your loan officer. If you don't have a loan officer, feel free to reach out to me directly. Like, comment, subscribe, the whole 9 if you can. And if you have any questions, as always, feel free to reach out. I look forward to talking to you in the next video. Take care. Talk soon.